Welcome to this in-depth explainer. Let's just dive right into it. Today, we're taking a highly knowledgeable deep dive into the complex and frankly fascinating world of foreign currency risk. If you've ever found yourself wondering how multinational companies survive the absolute roller coaster of global exchange rates without going bankrupt, well, you're in the right place. We're going to unpack the heavy math and the macroeconomic theories driving currency markets, and we'll break them down into clear, actionable strategies.
Here's our roadmap for today. We'll be looking at 1. The threat of transaction risk. 2. Basic currency risk defenses. 3. Advanced hedging with forwards and markets. 4. Hedging with financial derivatives. 5. Forecasting future exchange rates. And finally, 6. Translation and economic risks.
All right, Part 1, the threat of transaction risk.
So, let's make sure we're on the same page with our terms. In the foreign currency world, transaction risk comes down purely to timing. It's that awkward delay between agreeing on a price and the actual cash changing hands. But here's a somewhat counterintuitive point. In finance, the word risk literally just means movement. Because currency risk is a two-way street, these exchange rate movements can actually result in favorable, surprise gains just as easily as they can cause devastating losses.
Let's ground this theory in a really specific real-world scenario. Imagine Company B. They're an importer based in a country where the local currency is the US dollar. Now, they've got an invoice for 180,000 foreign pesos due in exactly 1 month. When they originally recorded the transaction, the rate was 2 pesos to the dollar. That means they're expecting a cost of $90,000. Simple enough, right? But during that month, the dollar weakens by 10%, dropping to 1.8 pesos per dollar. Suddenly, they have to spend $100,000 to buy those exact same 180,000 pesos. That 10% swing in the dollar just hit Company B with an unbudgeted $10,000 loss. So the absolutely crucial takeaway here is this. Exporters lose out when the domestic currency is strong, and importers lose out when it's weak.
And unfortunately, it gets a little trickier. You don't just get one clean, simple exchange rate in the real world. Instead, you get a bank spread, something like 1.7600 to 1.8000 pesos per dollar. And honestly, this brilliantly illustrates a golden rule of finance. The bank always wins. The bank is going to sell dollars to an exporter at the higher price of 1.8 and buy dollars from an importer at the lower price of 1.76. If you're ever in doubt about which of those two rates applies to you, just remember that your company will always be offered the worst rate. That's how the bank guarantees they make a profit on the spread.
Moving on to Part 2, basic currency risk defenses. Now, before jumping straight into complex financial products, businesses actually have quite a few internal tricks up their sleeves. For starters, they could simply invoice in their own domestic currency. This entirely shifts the transaction risk over to the customer. Though, a quick warning on that, it might cost you some sales if your customers aren't thrilled about taking on that risk themselves. Companies can also use a tactic called leading and lagging. That means paying suppliers early if the domestic currency is expected to fall, or delaying the payment if it's expected to rise. Furthermore, if a company has a ton of international transactions, they can use netting, basically only paying the net difference between their foreign receivables and payables. Or they can use matching, where they strategically use foreign currency loans to finance overseas subsidiaries, letting their overseas earnings naturally pay off the loan.
Part 3. Advanced hedging, forwards and markets. So, if those internal defenses aren't cutting it, the most popular external method for hedging currency risk is the forward contract. By entering into an over-the-counter agreement directly with a bank, a company can lock in the exchange rate today for a settlement that's not going to happen for months. It's a real game changer because it completely removes uncertainty. But, there's no free lunch. It comes with strict limitations. The contract has to be exercised on a very specific, fixed date. The rate the bank offers might not be all that attractive, and because it's a direct agreement between two parties, you take on what's called counterparty risk in case the other side defaults.
But what if you don't want to use a forward contract? Well, you can mathematically manufacture your very own forward rate using something called a money market hedge. Let's slow down the pace for a second and see how this builds step by step for a foreign receipt. Step 1. Identify the exact loan repayment required in the future that matches your expected foreign revenue. Step 2. Calculate how much you need to borrow today in the foreign currency, making sure to factor in their local interest rate. Step 3. Convert those borrowed funds immediately into your domestic currency at today's spot rate. Boom. Exchange risk is completely eliminated. And finally, Step 4. Place that money on deposit in your home country. You'll earn interest while you wait for the foreign customer to pay you, which you then use to pay off that original foreign loan. Honestly, it's a beautiful piece of financial engineering. Now, looking at those two options, you might be asking, which one is actually better, the forward contract or the money market hedge? Notice the two payment costs here for a 6-month settlement. A forward contract costs $149,604, while the money market hedge costs $149,602. We're talking about a mere $2 difference on a transaction of almost $150,000. This perfectly illustrates the interest rate parity theory in action. That theory explains that forward rates are mathematically determined by the interest rate differences between the two countries involved. Because of that, a money market hedge is rarely going to deliver a significantly different outcome than a forward contract, though it definitely requires a lot more administrative work on your end.
Okay, Part 4. Hedging with financial derivatives.
Let's step it up a notch. Two major tools in the derivative space are futures and options. Currency futures are traded on an exchange in large, standardized sizes. What's fascinating about futures is that the contract itself is totally separate from your actual business transaction. If your underlying transaction loses money due to a bad exchange rate shift, your futures contract is designed to mathematically make a profit to offset it, fixing your outcome. However, they do require you to place a deposit, called a margin, which you might literally have to top up on a daily basis. On the flip side, currency options act exactly like an insurance policy. You pay an upfront premium, and you get the right, but entirely not the obligation, to exchange currency at a set rate. This is fantastic because it protects your downside, but lets you keep all the favorable upside if the rates happen to move in your favor.
Now, if we're looking for a long-term solution, companies will often turn to currency swaps. This involves two parties literally swapping equivalent amounts of debt for a set period of time. It's an incredibly useful tool for restructuring the currency base of a company's liabilities. For example, say you're trading overseas and receiving revenues in a foreign currency, but all your corporate borrowings are back home in dollars. A currency swap allows you to match those foreign revenues against foreign debt, which heavily reduces your long-term exchange rate exposure.
Part 5. Forecasting future exchange rates.
It's literally the multi-trillion-dollar question: can we actually predict exchange rates? Short-term movements, highly volatile, pretty much a guessing game. But over the long term, economists use a specific set of interconnected theories, often referred to as the four-way equivalence model, to forecast exactly where a currency is headed.
The two main pillars for these long-term predictions are purchasing power parity and the international Fisher effect. Purchasing power parity states that exchange rates are fundamentally driven by relative inflation. So if inflation is high in a foreign country, the actual purchasing power of that currency erodes. Over the long term, the value of that currency is going to fall on the exchange market. On the other hand, the international Fisher effect looks at interest rates. Because global investors are always seeking similar real returns, high nominal interest rates usually just reflect high inflation in that country. Therefore, high interest rates generally signal that a currency is going to weaken in the long term. Both of these theories are absolutely vital tools for any risk manager trying to see around the economic corners.
Finally, Part 6. Translation and economic risks. Zooming out from individual transactions, the first of the enterprise-level threats we face is translation risk. Now, unlike transaction risk, translation risk doesn't impact your immediate day-to-day cash flow. Instead, it rears its head at the end of the year when a parent company has to consolidate the financial statements of all its foreign subsidiaries. If exchange rates have moved against you, the domestic value of those foreign assets just falls on paper. And even though it's not physical cash leaving the company bank account, it can seriously damage a company's reported profits. As you can imagine, that makes it a massive headache for executives trying to keep shareholders happy.
And that brings us to the ultimate, overarching threat: economic risk. This is the danger that long-term sustained movements in exchange rates fundamentally damage the net present value of your entire business. Think about it. Even if you never import or export a single item, an overseas rival might suddenly gain a massive competitive advantage over you simply because their local currency weakened. Sure, you can mathematically hedge a specific individual transaction using forwards or options, but how do you hedge your entire business model against a changing world? The harsh reality is that true defense requires strategically diversifying your international operations, making absolutely sure you're never overly exposed to the whims of a single global currency. So, I'll leave you with this. If your company's entire bottom line is tied to a single exchange rate, are you truly doing business globally, or are you just gambling on the dollar? Thanks for joining me on this deep dive.